Imagine you own half of a good little business and your partner is a madman. Every morning, without fail, he knocks on your door and names a price. He will buy your half or sell you his, your choice. Monday, he is euphoric and the price is ridiculous. Thursday, he is in despair and will sell you his half for the change in your pocket. Here is the question that has quietly made more fortunes than any stock tip in history. What is this man to you? A threat? An oracle? Or the best business partner imaginable? Precisely because he is insane and you are not required to answer the door. That thought experiment is called Mr. Market. It was written in 1949, and Wall Street still has not fully absorbed it. The Intelligent Investor by Benjamin Graham is the oldest book we will ever cover on this channel, and the reason is simple. Warren Buffett calls it by far the best book on investing ever written, and Buffett is not being polite. Graham was his actual professor at Columbia, and then his actual boss at the Graham-Newman Partnership. The lineage is direct. The greatest investor alive learned the trade from this text and says two chapters matter most, Chapter 8 and Chapter 20. So that is our episode, The Madman and the Three Magic Words. The first idea reframes what a stock price is. Graham's Mr. Market shows up daily with a quote, and the amateur mistake, the mistake entire cable channels are built on, is treating the quote as information about the business. It is not. It is information about Mr. Market's mood. The business, the earning power, the assets changes slowly. The quote swings wildly, which means price exists to serve you, not instruct you. Ignore him on the manic days and on the truly despairing days when he offers you dollars for 50 cents, transact. Graham survived the crash that began in 1929, was nearly ruined and rebuilt. This allegory is scar tissue turned into an instrument. The investor's chief problem, he wrote, and even his worst enemy, is likely to be himself. Second idea, Chapter 20. Asked to distill sound investment into a motto, Graham gave 3 words: margin of safety. Never pay a price so close to your estimate of value that you must be right to be okay. Buy so far below value that bad luck, bad timing, and your own bad judgment are all prepaid. Notice what this really is: humility converted into arithmetic. Every bridge is built to carry more than its expected load. Graham simply asked why your life savings deserve less engineering than a bridge. The margin of safety is the difference between an analysis and a hope, and it is the single Graham idea that appears in every serious investment framework since. Third idea, from page 1, the line between investment and speculation. An investment operation, Graham says, is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. And here is the nuance people miss. Graham does not forbid speculating. He forbids confusion, doing one while believing you are doing the other, betting the rent money while calling it analysis. His practical peace treaty: if you must speculate, wall off a small pocket of money for it, never add to it, and never let it near the serious capital. 2 games, 2 tables, 1 rule. Know which table you are sitting at. Why read a book from 1949 when markets now run on silicon? Because nothing in it is about markets, really. It is about the reader. Panic, euphoria, envy, impatience. The software Graham wrote defenses against has not been patched in 75 years. The ticker's changed. The madman knocking is the same madman. The Intelligent Investor by Benjamin Graham, with Jason Zweig's modern commentary. Read chapters 8 and 21st, like Buffett tells you to, then read the rest. And tomorrow morning, when the market opens and the knock comes, remember, you do not have to answer the door.